Hey friends, most easy way is to become rich is to buy the shares of any company. But a lot of people don't know what stock, share, and stock exchange are, and why any company sell its shares. So, today we will talk about these things in detail with examples. Stock. A stock represents ownership in a company. If you buy stock in a company, you own tiny part of that company. For example, imagine that you buy 50% of the stock of Tesla company, then 50% of Tesla company becomes yours. Share. Share is a single unit of ownership in a company. For example, if Tesla company stock has 10 shares and you own 5 out of 10 shares, then you own half of Tesla company. Stock exchange. Stock exchange is a place where I can buy and sell shares of any company. For example, if you have to buy shares of a Tesla company, you can go to the stock exchange and buy them, and if you have to sell, you can go to the stock exchange and sell them. The most popular stock exchange is NASDAQ and New York Stock Exchange, NYSE. Shareholder. If you buy shares of any company, you become a shareholder of that company. For example, if I buy shares of the Tesla company, then I will be called a shareholder of the Tesla company. Why companies sell stocks? A question comes to our mind about all of this. Why do companies give their shares to people? Its answer is, for expand their business or to work on a new project or to set up a new factory. For example, meet Jack, who wants to start a chocolate company. He needs $100,000 to start the company, but Jack only has $50,000. At this point, Jack has two options. The first option is that he goes to the bank and takes a loan, but he will also have to pay interest on it. The second option is that he sells some shares of his company to people and raises money and starts the business. Jack chooses the second option. He keeps 50% shares of his company himself because he already has $50,000. And the remaining 50% shares of the company are distributed among 5 people. And inspired by Jack's ideas, those 5 people buy the company's shares for $10,000 to $10,000. 5 years later, Jack's business expanded very well in the whole country. The value of the company increased from $100,000 to $400,000. And the investor who bought Jack's company's share for $10,000 has a share value of $40,000 now. If he sells his share today, he will have a profit of $30,000. Why people invest in stocks? The 5 people who invested in the chocolate company had 2 options while investing. The first option is to put his money in the bank so that the bank gives him an interest of 1% to 2% in 1 year. And the second option was to buy a share of a company, which would get an interest of 7% to 8% in 1 year. Then he chose the second option and invested in the chocolate company. Every single person invests $10,000 to $10,000, and after 5 years their money, $40,000, has increased 4 times. Risks and volatility. The share of the company is like a roller coaster. Sometimes it goes up, sometimes it goes down. Imagine if the chocolate company didn't expand. If there were not more customers, the company's share would have fallen from $100,000 to $70,000. So that would sink $3,000 to $3,000 of the shareholders' money. Remember that if you get more interest in investing in the company, then there will be chances of losing money. Types of stock. Common stock. Common stocks give residual interest to the shareholder. Residual interest means the net worth of the company that remains after paying off all its assets, liabilities, loans, obligations, expenses, etc. is claimed by all the shareholders. In simple words, the money that remains after the company pays off all its debts is called residual interest. Common stocks are risky because it is not certain that you will get a return. In simple words, if the company makes money, then it will give you money. Preferred stocks. If you do not want to take much risk and want fixed returns as well as ownership, then preferred shares are right for that. Preferred shares give fixed dividend, but voting rights are not available in this. Voting rights of the company means that if the company takes a decision for its work, then the preferred shareholder will not have the right to vote whether this decision is right or wrong. Advantage of preferred shares. Whenever a company is sink, first of all it repays the loan to the bank, then to the preferred shareholder, and then to the common shareholder. If seen, the preferred shareholder stands between the bank and the common shareholder when the company is paying the money. Investment tips. Before investing in any company, know it well in advance or what it wants to do in future. And yes, remember one thing, never invest all your money in one company. Otherwise, if the company fails, all your money may be lost. Example, if you have $10,000 to invest, then do not invest $10,000 in one company, invest $2,000 to $2,000 in different company.